formally begin the session. Let me take this time to say good morning, colleagues. My name is Mbegezeli Khumalo, Program Manager for the Techscale 6 program with YIEDI. And we are so happy to have you in today's session, very special session today, focusing on investment readiness, a really big part of the entrepreneurial journeys, getting people to believe in your product so much that they give you money to build something, right? They give you their own money to take a risk. Such an important part of the entrepreneurial journey. And I'm always reminded of the first investment pitch. Blake and Willem, you will laugh, but I think it was 17 years ago. I sent a guy, was an astute investor, well known in the industry, and I sent him. It was like a 40-page business plan, and I remember I added under potential clients. I went to Google and I said JSE companies. And there was a list of JSE companies, and I downloaded the logos of about 30 JSE companies. And I just pasted them, and I said potential clients, and it just said logos. And in my mind, that made perfect sense. Look at all these companies, I'm going to be rich, you know? And I asked this guy for 5 million. Yeah, you know, learning and growing. And every day when I speak to entrepreneurs, even experienced entrepreneurs, you'll still see someone saying, yeah, we need about 3 million rand for 30%. And I say, okay, tell me, where do you come up with this 3 million figure? Why 30%? Why not 29%? Why not 3%? And there's just no maths to it. It's just, feels like 30 mil feels like a 3%, 30% kind of thing, you know? And that's when you see that entrepreneurs really don't have a lot of information about how to raise capital. We really, really need to learn and understand better how investment works. And so we have someone who will.
Wait. Did you get the 5?
I never got the money, Willem. I never. Yeah, I got a coffee and yeah, coffee and some wise words. So that's about it. But yeah, we have a team here from Simple Capital with Blake and Willem from Simple Capital. I will go through the profile just now, but before we begin, today is a very special day in our group sessions. We have the CEO and founder of YIEDI with us, Jayshree Naidu, who would like to have a word. Great to have you, Jayshree. Over to you.
Thank you so much, Mbe. This is basically just a touch in, from the YIEDI team. We are behind the scenes. It was so lovely to see that some of you took up the opportunity to attend the Africa Tech Conference in Cape Town, and thanks to IBM, for sponsoring those seats at the event. I wanted to also take the opportunity to let Gift just say a quick hello, because Gift is part of the YIEDI team. Willem and Blake, we do these accelerators across multiple multinationals and, other programs across the country. But we try and pride ourselves in data-driven accelerators, and, we're trying to use diagnostics as the basis of how we design programs. And many of you would have received your diagnostics from Gift. Remember, diagnostics are a living document, so we will be working on those diagnostics. If you haven't received your diagnostic, please do reach out to us. It won't be for the development track, unfortunately. It's just those that are on the IBM Techscale core initiative that will have received those business diagnostics. Gift, I'm sure you're with us. If you don't mind just saying a quick hello so the guys can see who you are, those that you didn't have an opportunity to meet in Cape Town.
Yeah. No, thanks, Jayshree. Good morning, everyone. And yeah, for those who have met in Cape Town this week, pleasure to see you guys again. I really am excited to be joining YIEDI. Fun fact, I myself went through the IBM Techscale a few years ago. And I built a company, and I exited that company. So I'm really interested, like very excited as well, to just be back in the team and kind of understanding what goes behind. So I am the AI lead at the moment for YIEDI, looking at data analytics, particularly just around like the different entrepreneurs and businesses that we work with. This is also my background. I studied in the US. I have an MBA in AI and data analytics. Yeah, and I came back in the country like a few months ago, and super excited to be working with all of you. I now know all of your businesses in and out, so that's always a nice thing to see. Thank you.
Thank you so much, Gift. And I know Blake and Willem are sitting there. Oh my gosh, she's eating into my time and I've got so much content to cover. But what I would like to say is investor readiness has always been a very important pillar of the work we do on IBM Techscale. And I asked Mbe if I could please just step into the session so that I could stress the importance of us taking the content that's going to be covered today, understanding that there will be quite a bit of content covered, but also realizing that it does not end with just this session. And that's why Gift is on the call together with Mbe and the rest of our team, so that we can ensure you get ready to do those investment packs, those of you that want to take this opportunity to the next level, working and engaging with Willem and Blake, and we will arrange those sessions separately. So don't see this as, oh my gosh, and now what? What do I do? Gift will be there working with you, facilitating those conversations together with Mbe and the team, with Blake and Willem, because we want you to actually come out of this session with almost questions. What don't I know? And very often that's exactly why we do these sessions. It's not so that you sit in 2 hours and you understand everything about investor readiness. You almost understand what is it that I don't know so that I can ask the questions when I do have these high touch engagements. So with that, I'm not going to take up any more of your time, Willem and Blake. I know that you are in amazing hands with Mbe. Mbe, has been doing this with us for a good couple of years, and the entrepreneurs love him a lot more than they do me. So I'm so glad that you're going to be taking them through this very, very important topic, because it's all about how do I take my business to the next level, but also not undervalue my business and not rush into, investor type engagements. And we've seen that so many times with businesses. As always, entrepreneurs, I might not see you at every session, but I'm just a phone call away. I'm just an email away. So you're welcome to reach out to me if you need anything. But thank you, Mbe. I'll hand back over to you. Mbe, are you there? I don't know if Mbe is froze. Okay, there
I think I lost you for a second. There I am. Okay, cool. We're gonna have a bumper session today. Willem and Blake, looking forward to it. I'll just tell you a bit about Blake. He's an accomplished investment executive with more than a decade of experience across global and South African financial markets. Currently serves as the CIO at Simple Capital, where he leads investments into early stage global technology companies with transformative purposes and strong founder-led leadership. His work focuses on identifying scalable, high impact technology ventures and guiding them forward for sustainable growth. Blake and Willem, welcome. Good morning, and I'll hand over to you.
Morning. Thanks so much for having us. Mbe, Gift, Jayshree, it's a real privilege to be here. We got a lot of content to cover, but to do that, we thought we really want to serve the group in attendance today. So we've got some slides prepared that'll guide the conversation, but where we go deep and where we go thin really needs to be based on the value that people perceive from that depth. And so I'm going to ask for two things. Firstly, I'll ask Blake just to bring up the slides. And while he does so, it's extremely hard for a person in a digital room to look at a bunch of icons as opposed to participants. So if you have the bandwidth and the liking to be properly involved in today's session, I will appeal to you to turn on your camera so that we can have a two-way conversation as opposed to a speech. Much more value in the two-way conversation. And then in making today as interactive as possible, on the next slide, we've got a QR code that allows us to do some live polling and some live Q&A as we go through the content to see, is this an area that we need to dip a bit deeper into, or is this an area that we need to fast forward a little bit? So can I ask you, ladies and gents, this will help us to also see who's present in the room, to scan the QR code and come into this group where we're not going to sell you any insurance products or Black Friday specials. We will use this to poll, to engage, and subsequently, it provides you with a community of practice that have gone through a similar session where help is available. And as an entrepreneur myself, I can relate to the need for having a community around you, because oftentimes our families take the brunt of our pressures, and it is helpful to be in a space where people have an understanding and empathy for what you are going through, from which you can draw strength and sometimes just bemoan the fact that you got a bad safe note. So use the community, join us today. And I can see already that we have 1, 2, 3, 4, 5, 6, 7, 8, 9 people that have joined. I'll talk for a little bit more as we maybe wait for 2 or 3 more people. It looks to me like that's sort of 50%. Arthur says I can share the WhatsApp link in the chat. Arthur, I'm going to try and do that. Whilst that's going down, perhaps I'll ask Blake just to formalize our introductions and to deal with some of the legals around this, as we are an FSP that is verified. Arthur, thanks for that suggestion. Blake, can I give to you for a sec while I just quickly juggle the links?
Sure, thanks, Willem. Great to be here. Nice to meet everyone. Looking forward to the next hour 45. And then ongoing engagement thereafter. So I think this is just cursory as a FSP. We typically have to say this, that, you know, we're providing a lot of our market insight and real world experience, but, you know, we're not providing formal advice. Cool. So this is thanks, Mbe, for the introduction. I think yeah, that focused on the investment side of our business. We also, just to reiterate, we also are a corporate finance shop. And so a lot of our experience that we bring into today's session is on behalf of our clients and real world transactions that we've seen in the capital raising markets. So this is just a quick slide just in terms of that background. So what we're going to bring into today is our experience from capital raising, debt and equity markets, local and international. And then in this environment, particularly, there's been a lot of mergers and acquisitions. Sometimes companies have been under stress, and so large strategic acquirers have come in. And other times it's been, you know, a merger of equals. We've also got legal counsel in-house, and so we're going to touch on some of the legal aspects of fundraising as well. And this is from real world insights. Willem, do you want to take us over our key agenda for today? 3 core blocks.
100%. So firstly, to get investment ready. That's going to be segment number 1. And then segment number 2, which is perhaps a little bit more technical and dives a little bit into some of the mechanics. We'll gauge what type of mechanics to cover with y'all, is cracking the code of valuation. You heard Mbe open his gambit by saying, you know, the 3 million for 30% kind of conundrum. And we're very interested to see who we have in the room today. I'll put a poll up in the WhatsApp group just now, because if you're a finance leader of your company, finance founder, this will be second nature to you. But if you are technical or operational or ex-corporate or just plain entrepreneurial, this might not be within your wheelhouse. And what we do see, unfortunately, in a lot of the emerging economies is that a lot of the venture capital is nascent. It's a very mature industry in the US. Gift will tell you that. But in the rest of the world, there are pockets where it isn't. And as a result, some of the early players in that field have unfortunately earned themselves the name of vulture capital as opposed to venture capital. And when they realize that you don't know how pre or post money valuation works or how the instrument works, you oftentimes are at risk of being taken advantage of. And we want to help arm you with some capability and skill sets to defend against such onslaughts. And then, of course, the last part, it's all good and well to be an entrepreneur with a great product and you now have funding, but there are a whole bunch of compliance and legal issues that sit in the background that someone does need to take care of. And we'll talk a little bit about how to navigate that legal maze as we go along. And so those are the sort of three big buckets. Where we go deeper will be largely dependent on you, and where we go shallower, you can help us by saying, well, we know this, we fast forward. Blake, what I'm going to do now is to create a poll on the WhatsApp group that'll ask, what type of founder are you? What type, let me just type it as we go, of founder are you? And it will be interesting to see who we have in the room in the categories of, are you technical? Are you operational? Are you finance? And are you, let's say, ex-corporate? What categories am I missing here?
That covers most of them.
Yeah, Willem, just to, so you're going to put the link in the chat box, just confirming. Thanks, Willem.
Are you confirming with me, or are you telling me, Mbe? Should I do it?
Confirming, because
Confirming.
I see.
Yeah, the link
yeah.
is in the chat. It's there already.
Oh, yeah,
The
yeah.
link
Okay,
to
the
the
link.
WhatsApp group.
Yes, okay. So let me
To the
just.
poll, yeah.
The link to join
Right,
the WhatsApp group is in the chat. Once you're in the WhatsApp group, you're going to see the poll being live. So all you have to do then is to click on the link. I've got 2 more joiners here.
Yeah, it's back on screen as well, the QR code. So
There we go. Okay, thanks for that. We've got some technical, operational. We've got some finance people. Doesn't look like we have a lot of ex-corporates. And here is core finance and accounting ex-corporate. Okay, the votes are still rolling in. And Blake, what I will try to do is to try and share the outcome in a screen grab with everyone as well. But it looks like overwhelmingly technical and operational with some scattered finance. So that helps us gauge the depth of the conversation that we will then go into. Blake, let's go for it. Let's do from number 8, where we talk about getting investment ready. Now, a couple of key questions that you would want to ask yourself, depending on the stage of your business, which we'll also gauge in a second, is, am I raising because I need to scale, or am I raising because I need to survive? And how you approach those 2 answers is very different, and who you approach is also, of course, super different. From a staging perspective, the slide coming up after this one will show you how to just take a stab at where it is in the journey. And then the third question that you need to be able to answer is how much I should raise and using what type of instrument. So this is a graph that we use often. And I will just again caveat, this is when it goes right. We know that the curve doesn't in practice always look like this. It's a much more jagged tooth. And sometimes it doesn't go up as fast as we would like. But in the main, for the purposes of today's conversation, we've categorized the stages as the ones that are depicted on screen. And maybe what we can do is to ask a poll of to say, which part of your growth phase are you in? And I'll put that on the live poll right now. Blake, maybe just a quick overview of each of the stages while I poll us.
sure. So, cool. So I think this is a typical life cycle of a company, obviously founded and bootstrapped in the gray dots. It sometimes goes through a bit of a dip in the early stages. And then when you find yourself in the pink box, which we're assuming most of the participants on this call are, that as opposed to later stage, then you find yourself in a period where you're looking at your unit economics and how can you improve those. So, you know, every delivery that goes out the door, you're not losing money, for example. As you improve those, you eventually, and burning cash all the way, you reach a point where you have a line of sight on your break even. And in fundraising markets and discussions at the moment, that's a key question. It used to be all about show me revenue growth at all costs. Now it's about show me profitable growth and route to profitability and sustainability. So then you reach your break-even point where you're no longer burning cash or drilling earnings every month, and then you're sustainable. And then you can actually enter a hyper-growth phase, which you find yourself in the green dot. Once you've reached, you know, so that's kind of like your series seed, pre-series A, Series B. Series C and onwards, you start finding yourself where you're profitable, you find product market fit, you've grown well, and you suddenly find yourself where you've got private equity players knocking on your door. And so then you find yourself in that large private equity gray square there, where the investors are different. The ways of looking at companies are different. The valuation methodologies are different. And the players are different in that part of the market. And then obviously in South Africa, there's been negative listings, but we saw recently there was Optasia listing. And globally, I think the IPO window has been pretty muted. There has been initial green shoots of it reopening. But obviously those businesses that have reached that kind of scale, after their pre-IPO stage, they actually list. So yeah, I think this is a generic life cycle of a company, and it'll be interesting to understand where participants on this call are.
Blake, so from the votes that have come in, we've got 7 cast votes in the poll. The 3 of the 7 are from a creating traction perspective. So, ladies and gents, the blue dot on screen, and then that's now 4. Someone has voted in the meantime. The other 4 are in the growth stage. So we're talking green dot. You've climbed up the curve already, perhaps past break even. You've worked on improving your unit economics, and you are now at that stage where growth is the main agenda item. That helps us. Thank you very much for answering.
So quite bifurcated between those starting new ventures and those that have reached break even and beyond and now in hyper growth phase. Interesting.
So I guess from an investment readiness, some of the growth folks would have gone through a round of 2 of funding. So some of this will be familiar to you. We're going to be asking you to share some of those war stories with perhaps folks from the blue dot group, which, by the way, now Blake has grown in the background. We've got 6 creating traction and 5 creating growth. Very little in the middle, much more, as you say, bifurcated. And here it's great because the creating traction folks can learn a little bit from the growth folks. And for the growth folks, we've got some bonus material as well to help you in that endeavor. Okay, so that's super, super great in terms of the landscape and starting to form this interaction and dynamicism in the community that we're building here today. Blake, if we then go perhaps just to understanding investors, one of the things that I'll open up with before I give to you is you've got to know how to wear the shoes of the person that you are appealing to. Oftentimes, technical and entrepreneurial founders forget that they're dealing with a human on the other side that have also driven to work after a fight at home, kids perhaps spilling coffee on a new pair of pants, traffic, someone has got a cough. At some point, there are elderly parents. And so in the end, we are all still dealing with humans. And it behooves us to spend a bit of time thinking about who it is that we're actually tackling and what it is that they are looking for. I know that I'm looking for cash, whether that's in the growth phase or in the traction phase. I know I want to give away as little as possible equity, like that's standard. But what about some of the more in-depth stuff that sits behind the label of this investor? Because a local VC and a global VC, I promise you, operate very differently. Gift will attest to that. High net worths versus angels versus syndicates, very, very differently. So Blake, why don't we lean into some of these investors and tease out some of these shoes that we need to wear and the things that we need to be aware of in the main as regards these types of investors?
Yeah, so I think the overarching principle is when you're setting up your fundraising strategy, you've got to understand what category of investor you're talking to and try and put yourselves in their shoes and how they think and really try and understand that investor. Most of the due diligence that's done is the other way, where the investor asks all the questions to the founder. But I think it's equally as important in reverse. So this is effectively a marriage. It's a partnership, and you've got to know effectively who you're getting into bed with. So it's important to understand, have you scoped the investor universe correctly in terms of category of investor? Have you done your research in terms of their mandates? What is the size of the investment, the stage of the investment, the geography, the sector? Do they have money? That's a key one. There's a lot of funds masquerading out there that actually have no dry powder. and will effectively use up your time and due diligence to learn about other portfolio, to learn about your company to benefit their current portfolio companies. What is the reputation of this investor in the markets? Are they predacious? Are they vulture capitalists, as Willem alluded to? Have they added tangible value to other portfolio companies? Have they exited other portfolio companies? And talking to other founders, the founder community in South Africa is quite small. So talking to other founders that have taken on investment is a great source of information. And in this market, the bargaining power is firmly in the investor's court as we currently stand. I think, 2021, for example, in the heat of the VC markets, the bargaining power is very much in the founders' camp. Money was abundant, valuations were sky high, and you can pick and choose your investors. In this environment, it's been a lot tougher. And so, we've seen a lot of predacious terms coming in with extra warrant coverage, extra dilutionary instruments that are attached to an equity instrument. But what's also important is understanding is that there's a lot of capital, there is capital out there. And if you are partnering with someone, what other value add can they bring other than just their money? Can they open doors from a business development perspective? They might want a board seat, but what value add are they going to present on the board in terms of sector experience and insights? So, yeah, I just think the overarching comment here is most of the DD is done by the investor on the company, but it's also important to understand, you mustn't just take anyone's money. And often, if there's cash runway concerns, investors do take on money because they're desperate and they don't want the company to liquidate. And so you end up getting into a partnership with people that you rue a couple of years down the line.
Blake, I put an asterisk next to that syndication one because it sparks a thought that I would like for people to think about. Given what you've identified as your stage of growth, there could be more and less appropriate types of funders to take on board. We know things like, categories rather, like angels are more suited to the very earlier stage, whereas global VC with typically US dollars or some form of a European currency that's a bit more stable, of which there's much more abundance, could be from a growth stage where the checks are larger. But there's a whole bunch of nuances that sit in the middle. And an interesting thing that we've noticed is the growth of syndication cash available. Years ago, talking 5-6 years ago, syndicates were tough to administer. Was quite an immature investment club type of approach. But the advent of technology and platforms to aggregate users in complex legal environments where money has got to cross borders to make it to the ultimate investment has matured. And there are now lots more companies, and as a result, a lot more trust from the investor community to put cash into some of these platforms that aggregate money in the form of a syndicate, typically SPVs, and then have a single line item on the investee company's cap table, which is SPV number 1. And where originally those types of deals could be 200 to 500,000 US dollars, modest numbers, maybe like $750,000. Today, we are seeing investors in the tumultuousness of the world, politics and economics, seek out alternative assets with greater than normal risk-free returns. So 8% in dollars doesn't cut it anymore. And of course, venturing is a asset class in which that type of return is actually quite disappointing. And so now the scarcity is not capital. Even at the beginning stages, as well as the later stages of venture, syndication is starting to play a role. Companies are now raising $5, $6, $7, $8 million through syndicates and professionals that aggregate that cash. So be on the lookout for that as a potential new alternative source that's really gaining traction and popularity in the world as more and more trust in technology starts to evolve. And then, Blake, one other point that I would just make to your key points of, what do they bring other than just cash? A question that we often ask ourselves is, will you have this funder over for dinner in your house? So can you forge a relationship that goes beyond just transactional cash in and strategic door opening? Can you work with this person on a stress tested type of canvas and environment? And if that answer isn't yes, you must ask yourself if this is the right partner. So that is a critical thing, and almost like a little litmus test colloquialism that we use internally is, would you braai with this person, or break bread at the dinner table of the family? Okay, thanks, Blake.
I think to add to that is also, like, I think some founders initially get trapped in the mantra that your investors are your friends. So I think, over time, you do the litmus test to say, would you braai with this person? And you can develop a relationship over time. But I'd say a little bit to the counter of that is that investors, at least in the beginning, may seem to be your friends, but then when the tension comes in and the talk comes in, that's when things can get uglier. So yeah. Okay, moving on. So I think this part of the section on investor readiness is now, we've tried to articulate what a typical founder would need as a checklist to go through to maximize the probability of success of a successful funding round outcome. So I'll carry on from here. So the first is you need your toolkits and your arsenal to go to war. And typically, your generic pitch deck, founder video, investment memo, your data room, and your financial model, as well as demo. So digging into this, well scripted and articulated investment materials massively impact the probabilities of success. And I think there's a lot of templates out there that work and don't work. So if we look at a pitch deck, for example, 10 pages or 10 slides, you don't want 30 slides, 50 slides. And in there, there's what we found and honed over the years is that there is a repeatable formula that allows you to cover what's required, which Willem will touch on the next slide. But effectively is, what is your company's mission statement? What is the problem you are addressing? What is the solution? What is your team? Give some financial traction stats. Give the investor a roadmap in terms of the funding strategy, and 10 slides typically does the trick. We found, based on DocSend research, that it's probably 30
Blake,
seconds.
I'm just checking if I'm the only one losing you slightly.
You're crystal clear on my side, Blake.
Yeah, cool. Investors will sometimes spend a few seconds on a slide, 30 seconds on other slides. So you really have to capture their attention. And that's often where a teaser comes in, which you can attach to an intro email, which you can put behind a DocSend link that is just a easily digestible one-pager. The video, video content, there's a lot of research out there in terms of how engaging it is. It's very personal, and it really lands the message to help you get that first meeting. The investment memo, we typically stick to 10 pages. And the beauty of the memo is that it's a pre-written investment paper that often the analysts at the funds that you're talking to regurgitate as their own work and put into their IC pack for the investment committee. So you make their life easier, and most importantly, you get to control the narrative. We can't sit in those investment committee meetings, but we can influence the material that investment committee reads and digests. A very clear, concise data room, again, for which we've honed a skeleton over time to cover the core pieces of data that an investor would typically ask during the due diligence, preempting that. And it's basically going and dividing and conquering within the team and say, does this piece of information exist? If yes, put it in. If no, who's going to create it? And so you can actually spin up a very professional looking data room. It can be Google Docs, it can be DocSend, it can be more fancy paid for Ansarada type offerings, where you get to see how long the investors have spent in the data room and what material they've engaged with. And then the financial model is a key piece. I mean, numbers are really where the rubber hits the road. And so creating a forecasted income statement, balance sheet, cash flow, valuing the business on the appropriate methodology, which we'll get to just now. And then also what's useful is having a investor summary page, which allows them to toggle between a base, bull, and bear case scenario for the business, and also creates their investor return metrics for them in a nice digestible tab is what we would recommend.
Blake, I don't know if you can hear me.
Yeah, we hear you fine.
Yes. Is that Mbe? Who's
Hi,
talking?
Willem.
Sorry.
Mbe, is it you talking? Blake,
Can everyone else hear us? Can you give us a couple of thumbs up
I
if
just
you can
wanted
hear
to
us?
make sure, Blake, that your yeah, it's you can't just do just like 2 or 3 seconds. I was just confirming if anyone else has had those challenges, or if
No,
I think it's
on
just
my side, Blake
also,
and team have been perfectly clear.
Okay.
Mbe, this is one of those rare cases in life where I can say it's not us,
super.
it's you.
Okay, cool. Yeah, please do carry on, Blake. Thanks.
Cool. And then Willem, you wanted to touch on
Thanks,
demos.
Blake. Carry on, Blake.
Okay, thanks, Mbe. You wanted to touch on the power of demos.
Yes, absolutely. In fact, there are 2 polls, ladies and gents, in the WhatsApp group. It would just be interesting to see. We talk about the importance of the pitch deck. That's when you have finally got this fish on the hook, and it's almost like fishing where you have to put a little bit of bait. Someone shows interest, they take the bait, then you pull them in, and once you've got them in the pitch room, you have all this energy in the room and so excited to show them what's going on, and then you realize there's a spelling mistake on your pitch deck, or you put the old pricing in. And so much of this effort goes towards the solicitation of the investor to finally get them into your boardroom or to your pitch session, and then the pitch lets you down. What do you do there? I mean, preparation is key, so try not to have it, obviously. But when it is there, as the investing side, Blake and I can tell you, we are also human, and we also know that mistakes creep in. When you have a founder that is cocky around that, or tries to poo-poo it almost to save face, we start to ask a whole series of other questions around the integrity and the authenticity of the person, as opposed to just plainly owning it. Because I promise you, you are not the first person to have a faulty pitch deck, and you are not the last person to have a faulty pitch deck. Obviously, try to keep negligence out of it, obviously. But in the cases where you do find those things, and Blake, on the poll, 8 out of 8 votes say yes, we've come to a pitch where we've seen a mistake. I think I can give you confidence in saying it happens. How you deal with it is going to be the determining factor as to whether or not you continue down the path with the investor, or whether you try to consulting talk your way out of it. And if your investor is savvy, they'll say, this guy can bullshit. Maybe not such a great investment idea, or we need to turn everything that he says around more than once because he's so slick. And I just say, often entrepreneurs believe it's a great skill to fishtail out of that situation. We say it's better to own it.
And also one point to add is, please use a pitch deck. Please don't just shoot from the hip, because I think that comes across as, you know, it's disarray, it's disorganized, and it actually comes across as a bit arrogant. So, you know, you don't have to read the pitch. That also doesn't come across great, but having a concise pitch deck is important to provide structure.
Yeah. Blake, and then if I quickly switch the attention just to the demo, we say demo, demo, demo. I asked in the poll, I've got 7 answers there. If you haven't submitted your answer, please feel free to now. Do you use live or do you use pre-recorded demos? And I'll give you some insight from an investor perspective, and then a practical tip. A pre-recorded demo is great, but a live demo that works is the best. And as the entrepreneur, perhaps more so on the technical side, you will be worried that your production or your staging environments crash in the middle of a pitch. That has happened to me, so intimately aware of that pain. The practical tip is, I would say, go for live and have recorded as backup. Technology environments change. Scale providers change infrastructure. That's fine. Try to run it live to show someone the actual experience. It's worth much more in the premium of the psychology that you're investing with your investor. And if it does fail, show that you've had the presence of mind to be prepared and say, well, okay, that's obviously a connection issue now, or like a fundamental update issue. Here is last week's version, which we have pre-recorded for this exact eventuality. And now you're showing both foresight as well as confidence in your product that you're willing to do a live demo. And Blake, that would be my advice. The only other thing that I would add to this slide from a materials perspective is nowadays, with investors being humans and digital content being a flush, more so with AI creating a whole bunch of crap that we've got to sift through. To give you an idea, I get 60 solicitations from LinkedIn every day because capital is in my LinkedIn profile. So people are looking for money. How do I sift through all of that? Yes, there's a smiley surprise face. Exactly. I've now got to do advanced spam filtering to get the nonsense out. But in this age, we know that even in America, WhatsApp is taking off. So platforms of instant communication where 60 paragraphs don't work. You need bait or something with which to evoke investor interests, after which pitch deck, video, demo, data room, etc. become relevant. So what is that initial hook that you can circulate that takes someone 15 to 20 seconds to digest, and use that to start the engagement at a quality level versus LinkedIn solicitations? Hey, we're doing a fundraise. And have you seen the latest trick that people do? Just following up on my previous email. I do this. I go check, was there a previous email? And in 99% of cases, there wasn't. They're trying to make me believe that I missed an email and FOMO for an opportunity. Doesn't work. So don't try that. Rather take that effort and put it into proper 15 to 20 second consumption materials that bring an authentically interested investor into your fray. Kizar, I see that you've unmuted. You got a question for us?
No, guys. Sorry, I just joined in from my PC. I was on my phone the whole time getting to the office. I'm finally here and now just have to swap over.
Okay, sweet. No problem. Blake, this is perhaps a thing if people say, okay, but what goes into my pitch deck? Everyone says do a pitch deck, but what the hell do I address in that thing? Because my business is so big, I'm so enthusiastic around it. How do I have a structured, disciplined approach towards communicating things? Now, ladies and gents, I can tell you more than 80% of the world's fund managing sits under the control and management of individuals that come from the East Coast, from the US. And in that East Coast, the universities all teach a framework of determining whether or not something is a good idea to look at for investment purposes. And what we've done on screen is to distill those sets of learnings into these 10 points. And typically, as the investor on the other side of the check, I can tell you that our heads work like this. Mbe starts pitching his idea. We first listen for, look at the inside. Blake, I don't know if your mouse can hover over, but that customer value proposition. And that customer value proposition is not simply, yes, I have one. That is detailed. Who is the customer? What segments do they fit into? If you're a platform company, you typically have customers on both ends, on the supply and on the demand side, that you are serving with some sort of a value proposition. And that value proposition cannot just be price. It needs to be value. It needs to be removal of friction. There can be qualitative and quantitative aspects in there. So each of the 10 bullet points that you see on screen probably have 2 or 3 pages behind it, which you need to distill into a drop penny, easy to understand pill that someone can digest and go, this is a great idea. And what we've seen is that investors literally make a list, 1 to 10, and they, as you're talking and waffling and going on and your pitch deck isn't structured, they are trying to disseminate a tick of green or a cross of red or maybe an orange highlight to say this could be solved. Let's hear if this entrepreneur has thought about this. Or if we question him, does he become defensive, or does he actually say, yes, here's how I think that valid risk or that valid concern could be mitigated? So customer value proposition. Who's your customer? What's the value that you're adding? Who's going to manage the tech and the operations? Because management skills are rare in the world. Lots of entrepreneurs, lots of side hustle, but professional management, expensive and rare. Then, have you done actual numbers for unit economics? If you give me a 10-year hockey stick, Blake and I look at you and go, yeah, not so sure this person isn't on something, because 10 years is, you maybe teach us how to travel into the future, but no one knows that. It's crystal ball gazing. So we look for 3 months, 3 years to maybe 54 months of indicative model illustrations in which you show us how revenue is going to be made, what unit economics should look like or could look like. And then I won't go through all of these in this amount of detail. I'll go faster now, but the one that I want to just pause on for everyone here is the go-to-market strategy. In our world, there's a golden rule, 110-1. 100 people talk about starting a business or pursuing a revenue stream. 10 actually do, 1 is successful. That means 9 aren't successful. Of the 9, 7 of the 9 are not successful for the same reason. And that reason is they struggle to get to the market. So in all of these pitch decks, our number one thing that just think of the world of venture, right? We make 43% on average IRR, on average. That's a normal curve, which means that some guys do 100% and some guys do 0%. All of us are subject to 110-1. So if I can go 110-2, I should go to 80% IRR. If I go to 110-3, I should be sitting in the hundreds in IRR. And if 7 of the companies that we invest in a portfolio typically fail because they cannot go to the market appropriately, imagine if we could solve that. What would that do for our returns? So when we listen to you talk, we listen for how are you going to the market? Direct marketing, billboards, partners, solicitors, commission people, revenue share. How are you packaging this to get to the actual person that's going to pay for this? 7 of 9. Do not underestimate the power of addressing this in your pitch deck. And then the obvious other things around team, partners, investors. I'll make one more comment, Blake, if you just go back one for me on the competition. In South Africa, we often see competition as a reason for people to sag their shoulders. Someone's already thought of this. Someone's already doing this. We love competition. It validates that the value proposition is actually real. Without competition, you are the only person in the world thinking of this. Now, you could be Einstein, or 99.9% of the time, you could be wrong. Whereas as individuals, backing a person would we rather put our money. So competition, don't hide it. Showcase it. It proves the concept. It proves the revenue stream that you're trying to pursue. So this is a great slide to take perhaps a picture of and say, I should be building these things into my deck. Sorry, Blake, I went off piece there a little bit, but I thought it was important.
No, I actually bumped my mouse. It wasn't intentional.
Thought I was getting the sign. Move on. All right, go for it. Let's go into the checklist.
Okay, so I think we will touch on this in the legal section, but it's really important to understand what instruments you're going to use to raise the capital. I mean, in early stages, safe notes has become the standard document, but in recent times, it's fallen out of favor. The convertible notes is also widely used and is the preferred instrument by investors at this point because it's debt until it converts into equity. So you rank higher up in the cap table. And then if you're actually doing a priced round where you're setting the equity share price, either preference shares or ordinary shares, that's where your priced equity comes in. So we'll touch on some of the rights and some of the legals just now, but it's important to understand and to articulate to investors what the investment opportunity is and what is the instrument. I think Willem's mentioned quite a bit on this already, so I won't touch on this. I think this is an important one, is use of proceeds. I think
actually, sorry, Blake, sure. I'm so sorry to interrupt you. Please just go 2 back. You said something about safe and here PE, yes. Convertible note. Let's pretend I'm the only one in this call who doesn't know what these things mean. If you can just explain these words. Let's pretend I'm the only one. Everybody else knows except for me. If you can just explain what these sure. 3 headings there. Safe, convertible note, what on earth is that? And then PE, thanks.
Sure. So, I mean, I think we've got a section on this coming up, but just quickly, we will dive into some details. But quickly, a safe note is a simple agreement for future equity. It is an equity instrument, and it converts at a future date, which is typically a priced round when there's shares issued for a set price, or there's a change of control or a liquidity event. That is the trigger event for conversion, and that also applies to a convertible note. The important difference is that a safe note is equity, whereas a convertible note is debt. It has a defined maturity date, it has an interest rate, and it converts at either a discount to the next round or at a set cap. So a very important difference. It is debt until it becomes equity, whereas safe note is equity-like. And then your priced equity is your actual shares. When you're issuing fresh shares in your business, either preference shares, which rank ahead of ordinary shares, or your ordinary shares. Willem, go for it.
What I can also say is that, my background is finance, chartered accountant, and I ended up being a partner at Deloitte. And my audit responsibilities before I shifted to consulting was in financial services, which included banks, wealth managers, private equity. And in all that time, in 25 years of being a finance professional, at that point, getting to the top of the finance pyramid, I didn't know what a safe note was. We don't teach it in South Africa. It's in the South African context, it's a new concept, even though the technology of the architecture is now a little bit more old. And as a result of that, we've built a specific module that deals with what a safe is in super detail and how it works. And so that could also be a thing that people might be interested to consume as a module. We'll touch on the highlights of all these instruments today, but then there are also follow-ups that we could do as regards some of the more in-depth nuances of this note, which has made a lot of people a lot of money.
Jay.
Thank you so much for that, Willem. And that's exactly what I was alluding to earlier. There are some of these terminologies and instruments that we might need to go into a lot more detail. And that's where entrepreneurs that are on the line and those that are watching the recording later, this is where you need to now put your hands up and say, I need more time with Blake and Willem. And that might be a smaller group, but it's more intentional around a specific topic that they have seen you cover here today. So just bear that in mind, entrepreneurs, and in Bear Gift, let's take note of those that are interested in this after we do the check-in post to this session.
Thanks, Joshua. Colleagues, you'll just let me know and I will note it on my side. Thanks.
Right. I think we'll just keep record of the questions as well and try and address them. We can either address them at the time or we can circle back to them. There was one on later stage private equity, and there's another question on taking on ESG investment.
Yeah, I got the ESG investment covered in the WhatsApp group. There's also a poll to ask people what types of instruments they have used or what they are thinking about using. And that will help us also ascertain where there is experience in the room, either to draw from if you are someone that needs a bit of help and a fellow entrepreneur to talk you through it. Or if you're thinking about it, like the safes, that there could be a session where we help you understand that in a bit more depth. Back to you, Blake.
Cool. I just want to touch on this articulated use of capital. So I think use of proceeds is quite important, and it needs typically show it as a percentage based on the category of spend, and it needs to also flow into your financial model. I think that's a key theme for all the investment themes, is that the use of the actual numbers need to flow through from the financial model as the start into your investment memo, into your pitch deck, into your teaser. It all needs to talk to each other. Otherwise, there's kind of credibility considerations for the investor. But I think I just want to touch on this quickly, and it's typically not, we don't see a lot of this, but I think we try and get our clients to do this, as well as when we're looking at making an investment. It's important to give your investors a multi-year journey and a fundraising roadmap. So what is this saying here? It's basically saying there's, similar to the chart that we saw with the different colored dots, what is your stage? How much are you raising? How are you going to use that money? And at the end of that use of that money, where do you believe your key metrics will be? What do you think your revenue will be? And what's an indicative guide to where your valuation will be? And so I think this is important for stakeholders as well as management to guide towards a North Star, which is over a multi-year period. And it also allows your investor to say, okay, I'm writing a first check now, but what are you going to do with this money now and where are you going to be? And then if I write a follow-on check, what are you going to use that money and where you're going to be? And then investors can basically plot their return on investment at each series of investment. And I think what's important here is that when you're talking to a VC and you're a portfolio company of a VC that maybe has 25 to 50 portfolio companies, each of those portfolio companies are competing with you for the next dollar of investment. And so that VC will say, where's the best return on my next dollar of dry powder investment, and why should I give it to you? So I think this articulation and having thought through this, and this also leads to a strategic direction of the business. It leads into the finance function. It leads, so everyone is basically aligned to the North Star, and that is determined by the capital availability. Mbe.
Yes, gents, I'm thinking we can please at 11, maybe just have a 5-minute pause before we continue at 11:05. Otherwise,
Sure.
Loving the content so far.
Sure. I think we can just go to this basically. And then so I mean, we can actually just go to the summary slide here. So we were at articulated use of capital. I think you can see this is our fundraising checklist. So as you go through, you tick off what you believe you've done here. So I think, the legal and compliance we'll touch on. And then I think it's important to understand that your investment process is a sales funnel, effectively. You start at the top and it's got wide draws and it goes to the bottom where it's where you actually land the money. Now, a typical investment process in this environment, it shouldn't take this long, but it does, 6 to 9 months. Fastest deal we've seen is probably 3 to 4 months. Longest deal, 1 year and 4 months. So it's important to narrow the universe of investors to high fit mandate aligned investors that you approach. You circulate the investment materials. You then typically have an intro meeting and maybe some follow-up meetings. The investor will typically have their first investment committee meeting where their team is aligned that they think this is a good opportunity, and they can allocate the time and the budget to that team to do a full DD on your business, which takes a long time, 8 weeks, 12 weeks sometimes. So, and it's a lot of time, dedication, a lot of money. And then typically after that, they will then go to the second investment committee where they'll get the firm approval that DD is passed, and then you go into a legal process. Ideally, you can do legals concurrently or overlapping with the DD, but it often doesn't happen. At that point, you might have got through the DD, but it's in the legal point, the deal can fall over because there's a lot of nuances and terms around control, governance, etc., that could cause a deal to fall over. And that legal process can take up to a month. So I think what's very important is understanding the different stages of investment. Also, different types of investors have different investment cycles. So it's important in your initial meetings with the investors, or if you've got a good advisor with you that can give you the insight, you understand the length of the investment process and what's going to be required. Okay, and then a backup plan. I think this is always, you're going to have plan B and plan C, because a 9-month conversation with an investor can fall over on an email.
Yep.
I think that's really important. You get strung along for a long time. Suddenly, an investment committee member who wasn't part of the DD, who wasn't part of the deal, just doesn't like the sector or had a bad investment, or just woke up on the wrong side of the bed. Things can fall over, and if you've run out of your capital over a 9-month period, backing this horse to fund you, and then it falls over, what's your backup plan?
Like on the backup plan, if I might also suggest, again, we are dealing with people, and you never want to be a horse trader. Haggling is not a skill, it's a thing actually to avoid. But having a B plan, if your A plan starts to take long, can help your A plan make up its mind quite quickly. I.e., if you're not taking the deal, I've got another one who is interested, but that cannot be disingenuous. So that is a fine line to walk. But what we have seen, unfortunately, in the aggressive capital world is that there are companies who make you believe that they're going to do this investment. And then they string you, as Blake says. You start running out of cash, which means your desperation goes up. You haven't formulated the B plan. And now how much of your company they're taking, having strung you out, knowing that you're desperate, becomes a battlefield, which you are likely to lose because you don't have the cash in the bank. So careful of that. This is a point that should be underscored. Jeshri, I see your hand is up.
Yeah, I know we're heading to the break in bed, so I won't take up too much time. But I think it's a very valid point you made, Blake and Willem, because I sat on a telecom investment committee, years ago. It was a 100 million rand investment committee. I think I was the least qualified from a financial decision-making perspective, who gets the funding. But like you said, it's important for the entrepreneurs and the businesses to understand that committees are made up of individuals, and each one of them are brought onto the committee for a specific reason. And even individuals like myself that might not be able to go deep into the financial, health of the business had a really strong voice from a committee perspective because of the background or the influence that you hold at a certain time. So it's up to the beneficiaries as well to do that research and understand every single decision maker that may have an influence on the outcome of that pitch or presentation that they're doing. So very, very valid and important points to consider as beneficiaries as well.
Yeah. Well, that's real life experience right there. I like to think of the investment committee as a choir or an orchestra, and each one plays a slightly different instrument. And if you're going to be successful in getting that whole choir or orchestra to play the same music, you've got to tick off a lot of boxes in people's minds, sometimes that they don't articulate. And so to try and help you with that, we've put the slide together that's on screen now. What mistakes have we seen that you could probably avoid? So first one we've touched on now. It takes longer than you think. We have a rule of thumb. We say, how long do you think it's going to take? Take that original budget of time times 2 times pi. That's how long it's going to take. For instance, I show up and I wing it. There might be investment committee members that take umbrage with that because you look unprepared and disrespectful. Vague capital deployment plan. Well, it sounds like this guy needs a new Ferrari or expensive, school kids fees. So unless you can tell me how you're going to spend the money, I'm unlikely to give it to you. And you can imagine a frugal, more accounting type personality and risk personality on an investment committee will look at that. Whereas the energetic leader visionary is going to say, yeah, let's give money. And you've got to get both of those to agree. You raise too little capital. So you spend 9 months raising and you raise an inadequate amount, which means that the moment the check comes in, you start your process again. When do you build your business if you're on a perpetual fundraising cycle? So please take a screenshot and think on these bullet points that we've articulated here. Perhaps as we go into a break, my watch says 11:06. Blake, I would suggest making a cup of coffee, reading one email, and going to the bathroom. You can do 2 of those 3 things if we give you until 11:15. That's 8 minutes by my count. Just to refresh, take the bio break, and then come back, and then we'll delve into the second part of the conversation.
Great. And then maybe during the break, if maybe the group can just think about what your key takeaways from this investment readiness section is before we go on valuation and legals. And then also, if you're willing and you have raised capital before and you did feel retrospectively you made a mistake, why don't you tell us about it?
Perfect.
Cool.
Thanks, Blake. Thanks, Willem. 11:15, colleagues. That was a sprint. That was quite an intense sprint. So let's make some coffee and we'll be back 11:15. Thanks, colleagues.
Thanks, sir.
Thank you.
Okay, colleagues, it's just gone 11:15. We are going to pick up the session to the second part of today's proceedings, focusing on valuation. Sure, that first sprint was quite intense. I hope that the colleagues have been noting what was mentioned by Willem and Blake. Really, what I pick up from this is just how you underestimate just how much deal flow funders and investors have, and how many times they do this. And you arrive the first time, like it's like buying a car for the first time. When you're buying from a car salesman, right? They're doing this 20 times a day, and for you it's your first time. And they can pick up when you're not ready. They can pick up when it's your first time. And I think the same can be said for investment professionals. Some of the things that you mentioned here, sure, I think a lot of the colleagues on the call are quite nascent on that, or their knowledge is quite nascent on that. And this is just showing me, to get serious money, you need to become a serious individual. To get serious money, you need to become a serious individual. And you need to know these things, and you need to be so fluent in this. So I hope that you'll be watching the recording after this. Blake and Willem, over to you on valuations. Thank you.
Thank you, Mbe.
Willem, I'm just noting the time. We've got until 12. So it's probably, let's call it maybe 15 minutes on valuation, 15 minutes on legal, and leave a little bit of time for Q&A at the end.
Yeah, I would even say, let's see how evaluation goes. If we have to do legal in a separate engagement, let's think about that, because evaluation is quite important. So, but let's go. You're right.
Cool. So the second module is all about valuation, cracking the code. So, we wish it was like this. You get a high valuation, you also get one, everyone gets one. It doesn't work like that, unfortunately. So we're going to delve in to what are the core methodologies here. So, those that have raised before and are more private equity type investors, you would have been more familiar with a discounted cash flow valuation. Those that are earlier stage pre-profit would be more familiar with a revenue multiple or price to sales multiple. Those with earnings can actually apply an earnings multiple. And so that's your EBITDA multiple or your price to earnings ratio. This is not really relevant for tech businesses, but some businesses that are more asset heavy are valued on their net asset value. So maybe there's a price to book ratio, or it's actually based on your net assets on your balance sheet. And this can come into account when there's been a lot of investment into a platform that hasn't yet garnered much revenue or commercialized. And so that's probably the best way to look at it, capital invested or your NAV. Investors will also look at your previous funding round, when you did it, what market conditions, what valuation multiple did you get at that point, and what were your core metrics of which that valuation was derived, and what are those metrics now? And then also looking at what's in the market. So, seed, Series A, Series B, where they're being done at, which jurisdiction, and which relevant sector peer companies, whether they are listed or private, are comparable transactions and comparable fundraisers to your business. Willem.
Blake, yeah, just a point perhaps to also seed into the thinking of individuals in this room. If you go back one slide, we made bold that part that says that someone is willing to pay for your company. Now, typically what they're willing to pay for a company is an income statement or balance sheet play, the likes of which there are known and mature methodologies of how to value your company. But just again, I cannot stress this enough, you are dealing with a person on the other side. So I'll give you a quick example, a healthcare business that we're involved in that is pre-revenue, that sat in a private equity office in Manhattan of a healthcare provider portfolio private equity company. Pre-revenue. So this healthcare thing that we're involved in doesn't make money yet. It got offered $200 million term sheet on the spot. Not because it has a wonderful income promise or trajectory, because controlling that company would help the private equity firm to cut overheads up to 40% out of their existing portfolio and make all acquisitions that are based on old overhead structures essentially 40% cheaper as well post-acquisition, which means we got it at a discount. So that has got nothing to do with our financial metric valuation, but it is someone that's willing to pay for it. And if you can understand that individual and the metrics and the dynamics that drive their perception of value, you might find that you're going to veer off-piste when it comes to known valuation methodologies that are financially focused. So I'm not saying all of them, but I'm saying it's an important thing to remember. You're sitting with people on the other side. Their perception of value could be driven by things that aren't driven by the same perceptions that you hold. So with that in mind, you'll still find probably 80% of the market does, if not more, some of these known methodologies that Blake is taking you through right now.
Yeah. Okay, so just to dive into each of these methodologies quickly and touch on a couple of key points. So what is a DCF? So a discounted cash flow, you basically forecast your free cash flow of your business out for 5 years, and you discount that back to today at an appropriate discount rate. That discount rate is called the weighted average cost of capital, which takes into account the weighting of your cost of debt and your cost of equity. And so what we find is that obviously valuing a business into perpetuity, at the end of the 5 years, there's a terminal value, which basically attributes a very large chunk of the value into perpetuity after the 5 years. And there's a lot of sensitivities when it comes to a growth rate and that terminal value. So that is one of the downsides of the DCF, is that a couple of inputs are incredibly sensitive, and the range of outputs that this methodology can derive can vary significantly. Okay, moving on. So your enterprise value to revenue multiple. So this is largely for pre-profit businesses that don't have cash flows or earnings. If possible, investors are buying into a forward-looking business, and so your revenue in 1 year's time is, on a typical trajectory, is going to look better than your revenue today or on a last 12 months basis. So you often can price a business on a 1 year forward or next 12 months forward revenue projection based on the predictability of that revenue that the investors can get comfort around. I think what we've seen the most in the market is 18 months forward, but even that, and probably in this market, it's probably a maximum of 12 months forward or next 12 months. What you can also articulate to investors, if you have very high growth rates, you can growth adjust your multiple, and it might be a higher multiple that they're paying now, but if you can illustrate based on your forecasts, next 12 months or 24 months time, given the growth trajectory, that multiple that they pay, say it's 10 times or 5 times, actually unwinds, means that it reduces. And you can show them how the price that they actually paid on a forward basis comes down. So how do we get revenue multiples? So if you look at listed businesses, you look at private businesses, there's private data sources. And then the listed businesses, it's widely available public information, but you need to make adjustments to what public companies are trading at. So first of all, they're public, so there's a lot more liquidity. So you're going to have to make an illiquidity discount for if you're a private company. Maybe there's unique characteristics, like your particular business has client concentration risk. 50% or 70% of your revenue comes from one big client. They're going to mark down your multiple. And so this is where the art comes in. You might have a headline revenue multiple, which is validated by a number of third-party sources, but then the investor, based on their perception of your business, is going to make company-specific adjustments to that multiple to derive the actual multiple that they're willing to pay and the market is willing to pay for your business. Obviously, if you're looking at revenue, higher quality revenues are recurring in nature, longer term contract in nature versus businesses that have to constantly renew their pipeline. And so higher multiples are, for example, a SaaS business that has long-term contracts and sticky monthly recurring revenue will attract a higher multiple than a services-based business, for example. Okay. if you have earnings and you have cash flows, then as we mentioned, the EV/EBITDA and the price earnings multiples are applicable. Price earnings multiples are typically more for the listed space and private equity, but EV/EBITDA is kind of private equity and post-profit VC businesses. Again, there will be adjustments made, and we've just put an illustrative example, like not sure your business is going to get 15 times EBITDA multiple, but it's just illustrative. These are some of the typical classes of adjustments that are made. So country risk. If you're comparing your business in South Africa to business in the US, for example, there's multiple reasons why a geographic discount should apply. Diversification, we've mentioned the concentration risk. Growth outlook, if your business is growing a lot faster than a listed competitor or a private competitor, then you should mark your business up in terms of that growth adjustment. And then also size, like your business might be a lot smaller than a listed entity, and so you mark it down to reflect the differentials in size. So you then derive that adjusted EV/EBITDA, and you apply it to your next 12 months or your next financial year estimate of your EBITDA.
Like, I think this is a lot like, you know, if you're building an AI business, you yourself need not necessarily be the in-depth engineering expert in AI. You have that in your team, but you need to know enough to be able to talk commercially sensibly about it and to design around it. And in the same way, if you're a non-financial founder, we are not saying learn how to do DCFs and learn how to do, you know, this type of conversation in detail. We're saying know that this conversation happens in the boardroom where you're asking money from, understanding the kind of things that they are debating and adjusting you for. And if you then have this understanding, you can steer your CFO and finance team towards arming you and being prepared for this conversation, so you don't get, for instance, on diversification, rated down because you possess information that you just didn't think was relative to provide this funder with, that perhaps could have negated how much you're rated down by. So please, we're not trying to teach MBA finance in an hour. We're trying to say this is the conversation and how it happens when you leave the room. Know that it's going to happen, arm yourself, and then prepare/position for it.
Right. So, I mean, these are just some of the sources that we use, and it's also useful for founders to get a sense of where your sector is trading, where your peers are trading, and get a sense, if you haven't got a formal valuation done by an external party, you can also have a sense of where your business is valued. And as a founding team, you know, you can even value your business every quarter, and you can say, have I gone up or down based on the trajectory of earnings or revenue. But yeah, I mean, PitchBook, Crunchbase, Royal Parks Partners, a lot of these are kind of paid for services, and also in the private markets, it's quite frustrating because a lot of transactions, the details aren't disclosed. So companies won't volunteer their revenue or their earnings information. They'll announce a transaction, but they won't tell you what the multiple was. And so sometimes you have to go for these paid services to actually get access to that kind of information. There.
Maybe worth jumping in here just to ask the colleagues, who's actually done evaluation? Does anyone have a sense of the valuation of their business? At the Malini Peace Tweak, in fact, you with Malini.
You're putting me on the spot. No valuation has been done on this side of town.
Anyone else who has made an attempt at evaluation? Linton, maybe? Linton? I'll just lower my hand, and you can also write in the chat box for those of you who may have made an attempt.
Yeah, so I've kind of made an attempt at valuing my business in there.
Yeah, tell us a little more, Keys. Was it you just had a coffee and you said feels like a 10 million rand business?
Yeah, I mean that's how it started, right? That's how it starts. You sit there and you're like, I've worked out over the last couple of years. 10 million looks good. No, I'm just kidding. So I actually did sit down with a guy the accountant, and I looked at, okay, so I've done a bit of research on discounted cash flow models and things like that, and a bit on projection of revenue. So I took the last couple of years that we actually did, and the kind of multiple that we did over the last couple of years versus revenue, and we kind of sit between a 3x and a 5x kind of multiple over the last couple of years. So I took that and I kind of forecasted and then did a bit of a discount cash flow model. And basically went according to that, and came up with a bit of a number.
And was the number accepted?
We currently in talks, actually. They looked at the number and they were like, okay, they were pretty close to it. I think I came at about, for a certain percentage, I was at about 13.5 and they were at about 11. So we weren't that, I wasn't that far off for my first valuation. I think we were pretty close.
Fantastic.
Yes.
Did you lean on your CFO for that, if I could ask, or was there advisors around you that helped with the methodology? Where do you get the template for a DCF? Maybe some other founders can benefit from this.
Okay, so I'm just passionate about business and numbers, and I guess I just did a lot of research, and I find it fun, to be fair. I don't have a financial background, but I find the uglies of business to be super fun. So I just went ahead, did a bit of research. Obviously, ChatGPT is involved in that research as well. So took a bit of everything that I could, took some of the numbers. I leaned on the CFO for the balance sheet and all that kind of stuff, because that's the boring stuff I don't like, right? So I got him to actually give me the whole figuring out of the actual balance sheet and what's happening and what's the kind of profit margins and the revenue and all that kind of stuff. Took all those numbers, sat down, did a bit of it myself, and he happens to be a friend of mine as well, obviously. So he disagrees highly because he thinks I've discounted the model quite a bit. So he disagrees quite a bit with regards to the valuation that I've given. But so we were in loggerheads with that. But I think this was me, and hence the disagreement between me and him.
Okay.
But
Are you a technical
it
founder?
sounds like you were quite measured and grounded in your approach. I think what we see is that if there is some inexperience around valuation, I think founders often get stars in their eyes and believe that their baby is worth inordinate times more than it is actually worth and what the market will pay for it. So it sounded like 13 to 11 wasn't a million miles off, and your assumptions were reasonable. And I think that's a key thing. It's like, I think you've got to be on the same playing field. You might be in different halves or in different 22s, whatever analogy you want to use. But in order for a deal to get done, you've got to be on the same field initially and negotiate around that. So,
yeah, and it's not even for complete acquisition. It's just for percentage buy-in. Yeah. So it actually wasn't that bad of a valuation according to what they've told me. But yeah, so I guess we still kind of seeing it, and I guess it's going to be fun. Yeah.
Like, this reminds me, because now when you have your number, and Kizar just said it, so please don't think this a punt per se, but there is massive value in going through some negotiation simulations before you show up in that boardroom. Because once you've said something, the other party is probably going to try and hold you to some of the stuff that you've said. So you want to be mindful of what you say and when you say it. And at the same time, not go into horse trading and haggling, because that's not really negotiation. That's just painful. So there is a component and a module around finding what's called ZOPA, so Zone of Possible Agreement, BATNA, which is your best alternative to a negotiated agreement, and how parties can find themselves, and the art of exploring and uncovering information on the other side. And I would highly, highly, highly recommend that as an entrepreneur, you get involved in a negotiation module, whether it's us that help you or another resource. But do some negotiation modules, because even if it's not in the valuation side of your business, it will be with staff, it will be with suppliers, it will be with vendors. If you are an entrepreneur, negotiation is a part of getting up in the morning.
Yeah, it might be noteworthy to mention that this wasn't actually venture capitalist funding or whatever. It's another JSE company that's interested in just acquiring equity.
Nice. Nice.
That's interesting, because then there's obviously a strategic angle. And so, you know, that's the reason why you would take them on as investors. But then they are also, again, to the earlier comments around perceived value and how, you know, different parties look at value differently, is they know what their group assets are and their distribution channels, and your business can plug into that and unlock value for which, you know, they're not going to want to pay for, but they see that value.
Yeah, that, I mean, from the inside champion that I have, that's kind of, it sounds very familiar to what you're saying. So the guy on the inside's telling me pretty much the exact thing that you're saying.
Yeah. But it's also going to be a slower process because it's more bureaucratic. There's a lot more levels. So you're going to find that your deal's going to take longer. There's their legal, there's the kind of practicalities around dealing with a large corporate strategic buyer.
Yeah.
Blake, I have to, because you said that sentence. I'm sorry if I'm stealing a bit of the time, but I feel that this will help entrepreneurs. In South Africa, with VC being quite an immature and small market, PE growing, a lot of your acquisition sits in large corporate. Learn to negotiate that large corporate upfront with things that are fundamental to you, because we have seen firsthand where entrepreneurial companies get acquired by large corporate and suddenly find themselves with large corporate policies that they have to adhere to. For instance, we buy all of our computers from Dell. You might say, oh, hell, but we're on Macs. All of our stack is on Apple. Yeah, but that's the corporate policy. So guess what? You're going Dell. What? All of us have got leave policies. So 21.6 days a year is how much leave you get. You say, okay, but I'm a founder. I haven't taken leave in 3 bloody years. I rest when I need to. Yeah, well, that's now the policy and your paycheck's dependent on it. Oh, and by the way, here are your new KPIs, and they are delineated from your growth phase KPIs. Ladies and gents, I cannot stress enough the importance of you putting yourself through an armory and running the gauntlet on negotiation modules. Get it under the belt, because you're going to be negotiating day and night if you are an entrepreneur. And sometimes in unexpected places, like how to deal with big corporate, because the check is lacquer, but the policies and the procedures and the protocols are not always so lacquer. Amen. Okay, I'll get off my soapbox now.
Well, I think there's one important, so if you are dealing with safe notes, I think understanding the cap is crucial. This also applies to convertible notes. So if you can't or don't want to set the valuation of your business yet because you don't feel you've got enough metrics, etc., what often happens is a cap, a valuation cap is set. That means this is the value at which the investor at most will pay or convert their safe notes into shares. I think the importance of this is that, you know, many founders just say, okay, whatever the cap is, because, you know, we're pricing the deal later. The risk there is that you set your cap too low, which means you do, let's just say the valuation of your business is 20 million and your cap was 10 million. When it comes to that price equity round, your new investors are going to come in at 20, but your old investors are going to convert at 10, which means they take a much bigger chunk of your cap table, and it can result in some material over dilution too early for founders, which again, at a Series A level, you know, what the market is telling us is kind of they would expect at least 50% or control of the business to retain with the original founders at a Series A level. If you've taken on too many dilutive instruments too early and set your valuation caps on your convertible notes and your safe notes too low, you might find yourself underwater very quickly. And then it also affects your motivation. So if you over diluted in your baby and you're putting your blood, sweat, and tears in, and you don't have enough of stake in the pie, it's going to affect your motivation as a founder. Okay. Then I think Willem's put some of this on the